Mary redeemed a $50,000 cash prize playing Chumba Casino online.
I was only playing for fun, so winning was a dream come true.
Chumba Casino is America's favorite free online social casino. You too could have the chance to win life-changing cash prizes. Absolutely anybody could be like Mary. Be like Mary. Log on to ChumbaCasino.com and play for free now. No purchase necessary. Void where prohibited by law. 18 plus terms and conditions apply. See website for details. The voice in the preceding commercial was not the actual voice of the winner.
Welcome to Exchange Traded Fridays, a live podcast from ETF.com, wrapping up the week in financial news and how it affects ETFs. I'm Dan Mika, a reporter with ETF.com, and I'm joined by my colleagues Jessica Ferringer.
Hey, everyone.
Sumit Roy.
Hey, y'all.
And Heather Bell.
Hi, everybody.
All right. So obviously the big news that continues to drive a lot of the markets is the ongoing conflict in Russia, in Ukraine. But we also got the CPI report. Sumit, you dug into the CPI report. Give us the brief overview and your takeaway from it.
Yeah, so I'm sure everyone saw yesterday's data, CPI at a 40-year high, 7.9% growth on a year-over-year basis. And it's just the inflation picture isn't getting any better. The expectation was that inflation was going to peak sometime earlier this year, and then it's going to trend lower as the year went on. So the 40-year high in the CPI isn't really a surprise. We had a 40-year high for the last couple of months. That was expected, but looking forward, the market now has to suddenly grapple with this intense commodity inflation that's above and beyond what we already had. Now you have economists talking about how the headline CPI could rise more than 10% versus a year ago. That was unthinkable if you go back 4 or 5 months. And now you have people talking about how the supply chains are scrambled again because of all the turmoil in Eastern Europe and all the sanctions being placed on Russia. So I know transitory is a word that fell out of favor already, but now it almost seems ridiculous that we ever even use that word. And we're probably going to be dealing with uncomfortably high inflation all year long. That said, there's still a lot of unknowns. We don't know how this war is going to play out. We don't know whether Russian exports of raw materials will be halted. We don't know whether other producers of oil and other commodities can close some of that gap that's been created by the war. So there's still a lot of open questions with regard to when inflation is going to peak. At some point it will peak, but where and when? And then once things normalize, 6 months, a year, 18 months from now, where is inflation going to end up? And especially core inflation, which strips out food and energy prices. But regardless of what happens, the Fed is in an extremely uncomfortable spot ahead of its policy decision next week. It has to worry about inflation, but it has to worry about the economy as well, because supply side commodity shocks have historically had a significant dampening effect on economic growth. So we're probably going to get that 25 basis point hike next week, but I'm really curious to hear from Powell and the rest of the committee on what they think about everything that's going on. What do you all think? Should investors be doing anything ahead of that big meeting next week?
I mean, that's really hard to say because I can't, it's such a complex situation to figure out where exactly you can store your money. Right now, I think oil has declined a little bit after Saudi Arabia earlier this week said that it would be open to increasing OPEC production, which is quite a spicy take from that end because Russia is an observing member of OPEC. And there was quite a bit of a drop, and there's worry about the short-term demand destruction for oil from having prices up to, I think, almost $130 for the West Texas benchmark. Then you have just also this morning, the other big economic news of the day, the University of Michigan Consumer Sentiment Survey was dropped to the lowest point since 2011. And what's really interesting, if you look into the footnotes, you can see the breakdown of sentiment between Democrats, Independents, and Republicans. And the last time that that there was I believe a 4.8% point drop between February and March, this latest survey, that almost 5%, that almost 5-point drop came from Democrats only came when the Omicron variant and the Delta variant were declared variants of concern. So this is almost like another. So some, at least Democrats, are looking at this and thinking this is as bad economically as another wave of COVID, which is a very interesting way to phrase to frame it. But yeah, Heather, what do you think? I mean, is there any safety in this market right now?
I'm wondering if it's in commodities, actually. I was, reading The Economist, which is kind of my low grade obsession. And the article I was reading today was talking about how Russia is like the number 1, 2, and 3 producer of natural gas, oil, and coal. And then it's also producing uranium, which is it's the biggest source for the U.S., which I think is bonkers. And then it's also a major source of copper, nickel, palladium, and wheat and fertilizers. So I'm just wondering if that's where people should invest, because that's a shortage. But also, if Russia is the biggest source of all of those, I don't know I just don't know how available it would be to invest in. And it does seem like at the beginning of the year, Goldman Sachs had said that we were entering a commodities super cycle. So I'm kind of curious if that will be sustained.
Well, I think the other problem right now, if you're looking at commodities, is are you buying at the top? With so many, and we saw it kind of. It was almost like the toilet. It was almost like the toilet paper situation at the beginning of lockdown, where there was just all of these weird like toilet paper and all of these weird independent things had a supply chain shock that knocked. That caused like shortages everywhere. Jess, you wrote about metals earlier this week. I wrote about agriculture last week. What's going on in there? What were you looking at?
Yeah, so just on a bigger picture, metals overall have really been hot this year. So there's a few that I dug into in my article. Nickel prices more than doubled overnight earlier this week due to a short squeeze situation. And as Heather pointed out, the price appreciation there is really due to Russia being the third largest exporter of nickel. It's a really commonly used metal. It's in things that we're all familiar with, like lithium-ion batteries. But demand was already expected to grow. So that's happening in combination with these supply issues due to the economic sanctions. So that's really what's driving the price up. It's not just supply side. So if we look at JJN, that's an ETN that tracks nickel futures contracts. We saw it shoot up exponentially earlier this week. At one point, it was up over 140% year to date. It's now cooled down a little bit, but it's still up 62% for the year. Another thing that Heather mentioned was palladium. Russia is a top exporter of that metal. They produced something like 40% of the world's palladium production last year. And demand for this metal has been growing pretty rapidly, too. A lot of that's being fueled by the auto industry. It's used a lot in electric car manufacturing technology, which is something that, I think we've all noticed a greater focus there from automakers. So it's really just feeding into that increased demand again and putting upward pressure on the price. So PALL, the Aberdeen ETF that tracks the palladium spot price, that's their best performing ETF of the year, and that one's up 45%.
Yeah, and between that fund and Tucrium has also had an absolutely wild couple of days. I believe you wrote a little bit ago about how WEAT, the specific wheat futures ETF, they literally ran out of shares. They had to stop trading on what was it, Monday, Tuesday, because they had to send in a new prospectus to the SEC, allowing them to make more shares. I think if you went even just 2 or 3 years back in time and just told any of us that an agriculture commodities fund that charges almost 2% an expense ratio became so popular that it had to stop trading and reset itself, I think all of us would just laugh at this time traveler that appeared in front of us. Go ahead, Samin.
Yeah, it's crazy. I mean, commodities were left for dead. If you just go back 1 year, 2 years, JJN that Jess just talked about, this product only had something like $5 million in assets under management for the longest time. But now you look at it as $120 million in net asset value. So this is pretty crazy moves we're seeing in commodities. And I think, Dan, you phrased it really well. Would you be buying at the top if you buy commodities today? Because everything from metals to ags to energy has just gone through the roof. So this isn't necessarily going to be just a one-way trade. There is a lot of risk at buying at these kind of levels today.
It's after 10 years of commodities falling, though. I mean, if you just take a bigger picture look, I don't know, commodities were really just forgotten for a while. And I think a lot of people just didn't allocate to that. But this market's kind of really making the argument for diversification. And maybe you have that commodity sleeve because it is not correlated to equity and fixed income markets.
I feel like if the Ukraine-Russia war ended tomorrow, Russia would still be kind of ostracized in terms of like markets and stuff like that. So I feel like the prices are still going to be going up because there's not going to be any like mitigation of that.
I mean, it took Russia, 25, 30 years to recover from the fall of, to become reinvestable again after the dissolution of the Soviet Union. And really within the span of a week, they've become a pariah state again. So that is a really good point, Heather. I mean, Russia, as much as like its GDP number is relatively low and it's so reliant on fossil fuel exports, it's still the biggest country in the world by land mass. It still has all of these exports and resources that, in a world where we're still trying to grapple with the idea that a just-in-time a way of shipping things just isn't going to work after almost 3 years of a pandemic, and now geopolitical tensions and a land war in Europe for the first time in a very long time. That just complicates the whole situation further. And Sumit, going back to the discussion about what the Fed can do, I think the word transitory was being thrown around a lot simply because people thought that once the pandemic got under control, and thankfully we are, it seems like we're about to hit the a very comforting place where we can live with COVID-19, but it's not causing our hospitals to be at full capacity. That people can get back to work, the supply chains can get rerouted and recover from this shock. But now we've got another supply chain. Now we've got another supply chain issue with so much of the world's energy, especially European energy, being essentially persona non grata at ports, and all of these other, especially agricultural commodities, and including tech commodities. Ukraine is a big exporter of neon gas, which is needed to etch in semiconductors. So it seems very likely. So it seems all but certain that the Fed is going to hike in March, and they're probably going to be hiking throughout the year. But how do you resign yourself to the fact that inflation is going to be really, really high, and there's not really a whole lot that the Fed can do because there's so much. Because a lot of these inflationary issues are not due to loose monetary policy. There's stuff that Jay Powell probably wishes he can control, but he can't.
Yeah, and a lot of it's actually from fiscal policy, right? We had trillions of dollars of stimulus due to the pandemic, in response to the pandemic. So the Fed really had nothing to do with that. And the rate hikes are kind of a blunt instrument, right? What can the Fed do to bring down oil prices, commodity prices? Nothing, essentially. All they can really do is hope to slow the economy down and bring demand for all these commodities down. And that's essentially what it's going to have to do. But if the issues are supply shocks because Russian exports are getting cut off and semiconductor supply chain issues and things like that. The Fed has no direct control over that. The only thing they have control over is the broader economy. So they're going to try to put the brakes on that a little bit, and hopefully by doing that in combination with some of these supply chain issues abating a little bit, that can bring inflation down. But really, there's a lot of unknowns. I always talk about how the fact that absolutely no one predicted CPI was going to be growing 7% a year ago. So by the same token, I don't think anyone has any idea where it's going to be a year from now, right? People just did not predict this, and we're kind of in uncharted territory right now. So we'll just kind of have to take it data point by data point, and I think that's the same thing the Fed's going to do. Now, as for what investors should do, I think fixed income is suddenly a really interesting area. I know fixed income ETFs and things like that have performed pretty poorly this year. You look at the AGG, it's down something like 4 or 5% year to date, not great. But if you're a long-term fixed income investor, you're putting money to work month after month, year after year, higher rates are actually a good thing. I mean, for years, you were getting absolutely nothing in fixed income, in treasuries and things like that. But suddenly, these yields are starting to look pretty decent. You adjust for inflation and the yields are still really low. But eventually, if you think inflation is going to go back to a more normalized level, if you can lock in a 30-year at 2.5%, maybe 3% if it keeps going up, that's not a bad deal, right? So I'd be closely watching fixed income, and I'd be looking for opportunities if rates keep moving higher.
You bring up a really interesting point there to me. It's just that, as ETF investors and as us covering ETFs are looking at this situation, there is, kind of the short-term hyper volatility that we're seeing right now, with so many things being thrown out of whack so quickly. But you do bring up a good point as to, what are the long-term strategies for people who are not seeking alpha right now, which is really at the core identity of ETFs. That's, a lot of what it was founded on. Jess, what do you think about this dichotomy? And do you think, there are any longer term opportunities that may be good to have and to hold, while everyone's hanging on to the roller coaster of the S&P 500 line?
Yeah, for long-term investors, it's less about identifying specific opportunities and just making sure that you're, sticking to an allocation that makes sense, where your risk is aligned with your risk tolerance and ability to take risk. I don't really believe that people should change their whole portfolio based on potentially short-term events. So just keep the big picture in mind and make sure your allocation's in line with that.
Heather, any thoughts?
I guess I'm just wondering how short-term these events are. But yeah, I feel like it couldn't hurt people to add a commodities allocation. But to me, I know you've mentioned before, like roll costs and things like that, dinging commodities investments, but maybe the equities associated with commodities might be a good place to hide out for a while. I think that actually is a category that's popular with kind of inflation's fighting strategies with equities, is commodities related equities.
Yeah, I think that's a good distinction, Heather. Especially, you look at areas like energy, right? The energy equity ETFs like XLE, XOP, IEO. I think those are probably better from a long-term perspective than something like a USO, something like BNO. Like Heather mentioned, your roll costs are something you have to consider when you invest in commodities. You can't just hold barrels of oil or physical copper. You have to buy futures in most cases when it comes to commodities, and rolling those futures is usually costly. Right now, it's not costly because near month futures contracts are worth more than later month futures contracts, which is called backwardation. So in that case, you're actually making money rolling your futures over time. But historically you've had to deal with roll cost and contango and things like that. So if you pull up a chart of, something like USO or even DBC, which is a broad commodity ETF, they don't look that good. I mean, they're down, like in some cases 50, 60, 70, 80%, even though commodity prices themselves are sometimes near all-time highs. So that's something you have to consider. It's not really easy to buy and get exposure to commodities in the same way it is other asset classes. So I think commodities are a tricky asset class. Generally, you want to buy them when they're low. If you're buying them when they're high, it's really hard to say whether it's going to be an effective hedge the same way it would be if you were buying them, say, a year ago.
We're going to leave it we're going to cap off the conversation there. I think all four of us need to grab some sleep over the weekend and prepare for the Fed meeting next week. Thank you so much for joining us for Exchange Traded Fridays on with ETF.com. If you've missed any of the conversation, we will have a replay on our podcast. Just go to your favorite podcast distributor and search for Exchange Traded Fridays. For myself, Dan Mika, and my colleagues Jessica Ferringer, Sumit Roy, and Heather Bell, thank you so much and have a great weekend.
Mary redeemed a $50,000 cash prize playing Chumba Casino online.
I was only playing for fun, so winning was a dream come true.
Chumba Casino is America's favorite free online social casino. You too could have the chance to win life-changing cash prizes. Absolutely anybody could be like Mary. Be like Mary. Log on to ChumbaCasino.com and play for free now. No purchase necessary. Void where prohibited by law. 18 plus terms and conditions apply. See website for details. The voice in the preceding commercial was not the actual voice of the winner.